silver prices have suddenly exploded higher. In just a few days, silver jumped hard while gold continued hovering near record highs. But something strange is happening behind the scenes. Silver mining stocks, the companies that usually move even faster than silver itself, are barely reacting. Normally, when silver rises 10%, mining stocks can rise 20%, sometimes even 30%. But right now, silver is surging, and miners are acting weak. That disconnect is becoming impossible to ignore. Most analysts blame recession fears, rising costs, or weak stock market conditions. But those explanations don't fully explain what's happening, because the real reason may be something much bigger. A hidden pressure building inside the silver mining sector. And if that pressure suddenly releases, the next move could become explosive. Today, we'll break down why silver miners are lagging, what smart money is quietly doing, and the signals that could reveal whether a massive breakout is close. To understand why this matters, you first need to understand how mining companies actually make money. Imagine a silver miner produces silver for around $20 per ounce. If silver trades at $25, the company makes roughly $5 profit per ounce. But if silver jumps to $30, their profit doesn't rise by 20%, it doubles. That's why mining stocks usually move faster than the metal itself. Their leverage plays on silver prices. Historically, during strong silver rallies, miners often outperform dramatically. But this time, that relationship has completely broken down. Silver recently pushed to multi-year highs. While many mining stocks remain far below previous peaks, that's extremely unusual. And historically, these types of disconnects don't last forever. Here's what many retail investors miss. Large institutions don't buy mining stocks because they love silver. They buy based on momentum algorithms and volatility signals. When momentum weakens, institutional money leaves quickly. That creates a dangerous cycle. Funds sell, liquidity dries up. Prices weaken further. Then more algorithms trigger additional selling. Eventually, most short-term traders give up and leave. Retail investors panic. Momentum traders disappear. Speculators lose interest. And that's exactly where things get interesting. Because once weak hands are gone, the market becomes compressed. Like a spring being pushed tighter and tighter. And historically, when that pressure finally breaks, silver miners can move violently. Recent market data shows something important. Large institutional investors reduced exposure to silver miners. But they didn't fully abandon the sector. The detail matters. It suggests they're cautious, not bearish long-term. At the same time, insider buying has quietly increased. Executives and company insiders have been buying shares aggressively. And insiders usually understand their own business better than anyone. They see production numbers, future costs, and demand trends before the public does. That doesn't guarantee a breakout, but historically, when insiders buy heavily during periods of weakness, major reversals sometimes follow, and retail investors, most already gave up after previous fake breakouts and painful losses. Many traders are waiting for confirmation. But in highly volatile sectors, by the time confirmation arrives, a large portion of the move may already be over. Now let's talk about the bigger issue. Global silver supply. Silver demand continues rising because silver is no longer just a precious metal. It's becoming an industrial metal. Solar panels, electric vehicles, electronics, military technology. All requires silver. But mine production growth remains extremely limited. That creates a structural imbalance. Demand keeps climbing, while supply struggles to keep up. And when supply shortages begin appearing in commodity markets, prices can move aggressively, especially when investor demand returns at the same time. That's why many analysts believe silver miners could eventually benefit massively if silver prices continue rising. Because even a small increase in silver prices can dramatically improve mining company profits. The macro environment also matters here. The US dollar has recently shown weakness. Inflation pressures remain stubborn, and historically, hard assets like gold and silver often perform well during uncertain monetary environments. When investors lose confidence in paper currencies, capital tends to rotate into real assets. That doesn't mean silver only goes up. Volatility remains extremely high. But historically, periods of rising inflation and weaker currencies have often created powerful precious metals rallies. And if silver continues strengthening, miners could eventually catch up fast. Of course, there are still serious risks. If the global economy slows sharply, industrial demand for silver could weaken. If the dollar suddenly strengthens again, precious metals may come under pressure, and mining stocks themselves remain extremely volatile. That's why risk management matters. Many experienced investors never put huge portions of their portfolio into a single mining stock. Because while upside can become explosive, drawdowns can also be brutal. This sector rewards patience, but punishes emotional trading right now. Silver miners appear trapped between fear and opportunity. Retail investors remain cautious. Institutions are underweight, but insiders continue buying. At the same time, silver itself continues showing strength. The combination creates a setup worth watching carefully. Maybe miners continue lagging longer, or maybe this compressed spring finally snaps higher. And if history repeats, the move could happen much faster than most people expect. The important thing isn't hype. It's understanding the setup before the crowd notices it. So now I want to hear from you. Do you think silver miners are about to break out? Or is this rally just another trap? Let me know in the comments. And if you enjoyed this breakdown, subscribe for more deep macro and financial analysis. See you in the next video.